Everybody in the mainstream media has been talking about a recession.
I still think that we're going towards a recession.
Recession.
And unfortunately, what the Federal Reserve is doing right now is going to make the recession that we will inevitably have much, much worse. And this will likely cause many Americans to lose everything, including their job. I'm going to explain this to you in one simple, fast step. Step number one, let's go over, and you never thought I would use this phrase in a whiteboard video on macroeconomics. I can assure you of that. I'm not going to say it out loud because YouTube will probably demonetize me or something. But this is from the movie Zoolander. Remember at the end there when Will Ferrell was telling Ben Stiller, he says, "Kill the Malaysian Prime Minister." And Ben Stiller was out there on the runway, and all of a sudden his brainwashing clicks in. He's got that tunnel vision, and he's looking right at the Malaysian Prime Minister, and he's ignoring all of the celebrities that are popping up because he's got that laser focus right on the Malaysian Prime Minister. Well, it sounds funny. In fact, I even drew Derek Zoolander right there. That was my best impression of a stick figure doing blue steel. Where he goes. But this is exactly what the central planners at the Federal Reserve are doing right now in terms of this. The Phillips Curve. Let's go over this quickly. This is pretty much the altar that all of the central bankers bow down to. And it's actually quite simple. On the bottom here, it goes from 3%, 8%. This is the unemployment rate. On the left, we go from 2% up to 8%. This is the inflation rate. And all of these central bankers and Keynesians and professional economists, they all believe that there's an inverse relationship between the two. So if we have the unemployment rate all the way down at 3%, well, that would mean inflation will be a lot higher. So in this case, unemployment rate at 3%, that means inflation is going to run hot, let's say at 5%. But if the unemployment rate goes all the way up to 6%, then that means inflation will come back down to where the central planners want it at 2%. So this is really the framework in which they base all of their decisions when it comes to consumer price inflation. So if they want to get inflation down, which they're trying to do right now because it's above their 2% target, they get this Zoolander-like tunnel vision where the only thing they can see is the Malaysian Prime Minister. In other words, the unemployment rate. So right now the unemployment rate, let's say, is 3.5%, and they just ignore everything else. It's like that meme where the house is on fire and it says everything is fine. They're ignoring everything else and just focusing on how do we get this unemployment rate from 3% to 6%? How do we get more Americans to lose their job? And if you think I'm exaggerating their obsession over the Phillips Curve, editor, let's cut right to the internet. Let's go straight to a recent article from CNBC. Title, "This is the end of the beginning of the battle against inflation," economist says. Key talking points. U.S. inflation cooled in May to an annual rate of 4%, its lowest annual rate in more than 2 years. Okay, you think it's headed in the right direction. Oh, but you would be wrong. Remember Zoolander. We can't pay any attention to what the CPI is actually doing. We've got to focus on the Malaysian Prime Minister. Next key talking point. The central banks need to trigger a recession to force unemployment to pick up and create enough demand destruction. But we're not there yet. Says top Societe Generale, I'm sure I'm mispronouncing that, economist Koku, or maybe Cuckoo is a better way to say his name, Agbo Blau. The impact of monetary policy tightening often lags the real economy by 3 to 5 quarters. Okay, let's think about that for a moment. So when we go back to the whiteboard, whatever we go over, that's a result of the tightening that was done, let's say, 5 quarters ago. So even if we stopped right now and didn't raise rates, we'd still have 5 quarters of what we have seen over the past year, let's say. Just keep that in mind. But he highlighted that the excess savings, yes, because you average Joe and Jane, you've got way too much savings. How dare you?
How dare you?
Built up over the pandemic, created an additional buffer for consumers and households. So we need to make sure that you lose your job so you burn through your savings. So we create that demand destruction to get the inflation rate down to our target. I mean, when you say it out loud in normal speak, it sounds completely insane. But they have been so completely brainwashed by all the economics classes that they've taken, their common sense is completely out the window. Then he concludes basically by saying, you guys watching this video, because you have way, way, way too much savings in the bank, we need to continue to raise rates to break the back of inflation. We need to crush inflation by jacking that unemployment rate up. He's basically saying that our job as a central banker and a central planner is to make sure that you lose your job as quickly as possible. So now hopefully you can understand the insanity of all these trained PhD economists that work at the Fed, and it becomes crystal clear as to why they'll most likely exacerbate any recession that we have coming in the future. So we've got that house on fire meme that we showed earlier. We've got things that we talk about on this channel all the time. The inversion of the yield curve. It always points to a recession. Right now it's inverted by 100 basis points, for heaven's sake. Something we haven't seen since 1980. We've got shoplifting at all-time highs. Just recently, Target reported that they're going to take a $1.3 billion loss due to shoplifting. Well, if everyone's got a great job that pays really well, I mean, the unemployment rate is low, would we see shoplifting at an all-time high? I don't think so. And let's not forget about the buy now, pay later loans that 44% of Americans say that they're going to need in the next 6 to 9 months just to get by. And 21% of those people say that they'll need them just to buy groceries. Let's not forget student loans. Those are going to need to be repaid back very soon. And this is going to take us right into the bullwhip effect. That's all those businesses hiring because they have this sugar rush of stimmy demand, and they don't realize that that demand is unsustainable. That demand is temporary. So all of a sudden, that demand falls off of a cliff because of something like having to repay the student loans. So all the businesses start to fire all these people that they once hired. And those businesses, the retail, the hospitality, the bars, the restaurants, the cafes, the places that young people spend a lot of money, those are the major job creators that brought the unemployment rate all the way down to where it is today. But there's another key data point that we have to go over. It's the most obvious. What has inflation done over the last year? And then what has the unemployment rate done? All right, let's go down to these charts. And this is the month-over-month CPI for the last year. We go from 0% up to 1.2%. So June of 2022 is all the way up to 1.2% just for the month. And the year-over-year CPI at that time was about 9.1%. But then the very next month, we go down to 0. Then we go down to maybe a 0.1 or a 0.2. And since June of 2022, you can see how it's much, much lower than it was the 12 months prior, to the point where the very last print in June was 0.2%, which took the year-over-year CPI from 9.1% all the way down to 3%. So if the inflation rate has gone from 9.1 down to 3%, the Phillips curve would tell us that the unemployment rate should be much, much, much higher. If the unemployment rate was 3.5% right here, when CPI was at 9.1, well, then you would expect that the unemployment rate would go way up in order to get inflation down to 3%. Well, let's go over to this next chart, which is the actual unemployment rate. And you can see over the past year, when inflation has gone from 9.1 down to 3%, the unemployment rate has flatlined. It's done nothing. It has not gone parabolic, which is what you should have seen if the Phillips curve is correct. So my point is, everyone with some common sense who hasn't been brainwashed by getting a PhD can just look at the Phillips curve in the 1970s and look at it today and say this thing is complete nonsense. This is the last thing that they should be focused on. Oh, but wait, there is more. Let's not forget that in 2023, we are in a rolling banking crisis. In fact, we have had more bank failures in aggregate total this year than we did in 2008. You heard me right. The bank failures that we've had this year have exceeded what we saw with Lehman Brothers and Bear Stearns and the GFC during 2008. So this brings us to a very important question. We all know that inflation really went up and we had disinflation over the past year, but what exactly triggered the inflation to begin with? Well, most of you guys know it was the government's response to the cerveza sickness. They locked everyone in a cage. Usually that's not good for the production of goods and services. And on top of that, they gave everyone stimmy checks. So they had an increase of the amount of money in people's checking accounts, and you had a decrease in the amount of goods and services. What else would you expect other than consumer price inflation? But we have had the supply of goods and services return, not back to a normal level. It's not back to where it was, but it has gotten better. Okay, so then we need to determine what has happened to the amount of currency units that people have in their checking or at their disposal that would chase those goods and services and create that consumer price inflation or continued disinflation or possibly even deflation. So, editor, once again, let's cut to the internet.
Let's go straight to the Fed's website and look at what they call the H6 report, or the H6 data. This is a breakdown of the details of M1 and M2. So M1 money supply is broken down by currency in circulation, demand deposits, basically checking accounts, and then other liquid deposits, which 95% of them would be savings accounts. So just for the sake of ease, we'll say currency in circulation, checking accounts, and savings accounts. And when I look at checking accounts, I consider that high velocity money. Those are the main dollars that are out there chasing goods and services that would give us an idea of what we should expect to see with the rate of consumer prices. Now, savings, I consider that low velocity money, although obviously you can take your money from the savings, go into checking. But let's look at what has happened recently. I think this is going to give us some tremendous insights. So starting in December of 2022, we can see that the amount in checking was at a high, $5.134 trillion. And the amount in savings at this time was right around $12.474 trillion. So now we fast forward to the last report, which was May of 2023, and we can see that the amount in checking has gone down substantially, down to under $5 trillion. Now you say, George, that still sounds like a lot. Well, it is, but that's down $132 billion. And look at savings. It's gone from 12.474 all the way down to 11.370, a decrease in over $1 trillion. Now, it is true that most of the decrease in savings is going into buying treasuries, and those treasuries are used to pay off the Fed, as an example. So the aggregate total of assets on the balance sheet of the average Joe and Jane is still the same. But if we focus on checking, and if we are to assume that the increase in checking is what caused, or one of the main reasons that we had inflation to begin with, we should also assume that a massive decrease in checking, which is what we're seeing now, will likely have the opposite effect. In other words, disinflation, or potentially even a short spurt of deflation. And this is also consistent when we look at a chart of loans and leases in bank credit. So these are all the loans that banks are giving out right now. And obviously, this applies to the amount of currency units that are in circulation. You guys know as well as I do that the banking system creates the majority of dollars. It's not the Federal Reserve or the government. So you can see by looking at this chart that starting in March of 2023, the amount of lending has pretty much flatlined, meaning that the amount of loans that are being paid off are pretty much equal to the amount of loans that are being created. Well, why on earth do you think that would happen? Oh, that's right. We had a bunch of banks fail. Silicon Valley Bank, Signature, First Republic, they all went bust. So what happens to credit in an environment where risk goes exponential? Well, we have a credit contraction. If we have a credit contraction, then we have fewer currency units that are available to chase goods and services being created. So what would you expect to see happen to the rate of inflation? You would expect to see it come down, just like we've seen it come down over the past year. But in spite of all of this, because the central planners are so hyper-focused on the Malaysian prime minister, they might even continue to raise rates, which, like we said earlier, will make the recession even worse, will drive the unemployment rate even higher than it otherwise would have gone. And this could potentially cost millions of Americans, not just their job, but their savings as well.
For more content that'll help you build wealth and thrive in a world of out-of-control central banks and big governments, check out this playlist right here, and I will see you on the next video.